Okay, so this is our next Math at Work 11 lesson, and we're going to be continuing our work with financial math unit. So we've already done budgets, and we've looked at analyzing bank accounts, and we've looked at simple and compound interest, and this next lesson on investments is really going to focus on that stuff that we just did with simple and compound interest and kind of take a look at it in terms of investments, and then we'll do another lesson in terms of borrowing money as well. And we'll do two different lessons, one focusing on separate loans, then one focusing on credit cards. Okay, so this one will be, I think, relatively straightforward, and we're just going to talk about some different types of investments. Okay, so all right, so again, what we'll be doing with these investments is looking at using our simple and compound interest to analyze the different investments. But what I wanted to go through first was just to kind of overview a few different types so that when we look at these specific questions and we're seeing abbreviations for things, we at least know what they are, okay? So when it comes to investing your money, there's always a lot of different options you have available to you, okay? Now, obviously there are people who have jobs and their entire jobs are professional financial advisors, and they just provide you with advice and options of what their institution has to offer of the best situation that works for you, your money, and your future goals when it comes to your money. So we're going to kind of be our own advocates and our own financial advisors in this particular scenario, and we're going to just kind of look a little bit at some of the pros and cons of some common types of investment types that are available through most banking institutions, but we're not going to go through a crazy amount of detail with any of them, and we're especially not going to go into crazy detail with the stock markets. Okay, we're just basically going to talk about the different types, some basic pros and cons, so that we're aware of them. Okay, so our types of common investments that we can get at pretty much any common bank or financial institution, you've got your TFSA, right, which is a tax-free savings account, your RESP, a registered education savings plan, an RRSP, a registered retirement savings plan, a GIC, which is a guaranteed investment certificate, and then you've got mutual funds. All right, and we'll just quickly talk about each of these in these next couple of slides. So you guys may have already heard about some of these things. Those of you who are working, you might already be looking at doing your taxes and stuff like that. So a TFSA, again, it's a tax-free savings account. And the biggest draw on it, of course, is the fact that it's tax-free. So what that means is that you can put money in there, and then when you take it out, you don't have to claim it as income. So you don't have to pay taxes on that. It's basically just like taking the money and kind of putting it under your own mattress, and nobody really knows about it, okay? But in this case, it is still being tracked, and it's safer than just being stored under your mattress, of course. Okay, with a TFSA, it's pretty, easy to get. You can have it as long as you want. All you need to do to be able to open one is be age majority, so 18 or 19 years old, depending on the province, as long as you are a Canadian resident and you have a social insurance number. You don't have to provide proof of income. Right? You can, if you only just get a little bit of money for your birthday from somebody, that's something you could put in a TFSA. You don't have to prove to them that you make a certain amount of money per year. Okay. However, with TFSAs, there is a maximum amount that you can contribute, right? So obviously, if they're allowing you to take so much out, that's tax-free, they don't want you putting way too much money in there, right? So there is a limit, and it does change from year to year. You kind of have to check it. For 2020. The maximum amount that you can put into a TFSA is $6,000 for the year. Okay, I think anything over and above that ends up getting taxed if you bring it out afterwards. Okay, so that's a TFSA. RESPs, these are your registered education savings plans. Okay, so these are registered to an individual based on their SIN number, right? So the social insurance number. Typically, people who are buying RESPs are parents who are trying to save up for their children's future in education, right? So any sort of post-secondary tuition would be what an RESP is used for. Again, with this one, the interest earnings, so the interest that you earn in an RESP is not going to be taxed while the money's still in the account. Where it is taxed is after you take it out. But since with an RESP, you can only use the amount of money in there for education, and it's assigned to typically the student, what ends up happening is that the student is the one who claims the RESP as income, and that results in very little tax because if they're a student, they're not making huge amounts of money, not to mention they have tuition to go against the fact that they had this income of RESP. It's kind of like, well, here was how much I had to pay the university in tuition, and here's how much my RESP was worth. It's kind of a wash, so you don't end up having to be crazily taxed. Okay. Another thing that happens oftentimes with RESPs is that the government will typically come out every now and again with some sort of incentive for people to invest in them, right? Things like, oh, if you invest, if you put $500 into an RESP, we'll also match it. We'll put $500 in as well, right? Or if you invest $1,000, we'll invest $500 from now to now, or whatever the case may be, right? So it just kind of bumps up your principal, okay? The tricky thing with RESPs, like I mentioned before, is the fact that they can only be withdrawn for the sole purpose of education and paying tuition to qualified institutions. So if your parents have, created an RESP and then you don't go to any sort of post-secondary institution, that you're really limited with what you can do with that money. All right, so this is a drawback for some people. They don't want to put money in an RESP because they don't know what the future is going to bring for their child, and they don't want to have that money kind of pigeonholed somewhere where they can't get it, okay? And again, it's not that you lost it. There might be other options available, but it's going to depend on the situation. It's going to depend on the institution, and oftentimes they are limited, right? And typically, if you don't use the RESP for education at all, you'll lose the government incentive stuff that went in there, right? Because it's kind of the grant. The other thing with RESPs is they have a maximum kind of shelf life. You can only have them open for a maximum of 35 years, right? So, I mean, if your parents had one of these for you and you decide, no, I need to take a couple years and work, they can kind of hold off on it. But, if they got it when you were 5 and by the time you're 40, you still haven't gone back to school, it's kind of done. They don't have an option, right? Some options that you can do if you 100% decided you don't want to do it, parents can rename it, right? Put it in the name of maybe a different sibling who is planning on going to university, right? But again, there is some money lost with it. So that's kind of a drawback with RESPs. Then you've got your RRSPs, which are your registered retirement savings plans. Okay, and again, this is obviously used for saving for retirement, and it's in the name of an individual. So if you have a couple, both individuals will need their own. Okay. Again, RRSPs are tax deferred. So again, you're not paying taxes on the interest earned during the investments itself, but the second you withdraw them, every year you withdraw an RRSP, you are going to be taxed on them. Okay. And that income that you pull out gets added to your overall income for the year, so it could put you in a higher tax bracket, meaning you now owe more taxes, and it would also affect things like government benefits, such as like GST checks, right? So, I mean, not everybody gets those. It depends on what your income is, and if all of a sudden, by taking out money from your RRSP, you end up having, you're over the limit, you could end up not being able to get a GST check or less of one, okay? With RRSPs, though, you do have to have proof of income, okay? And how much you're allowed to contribute to them each year depends on how much you've earned per year, okay? The other thing with RRSPs is that you can only contribute up to a certain amount of time. Once you're 71, you're done. You can't put money into the RRSP anymore. At that point, you either have to close the account or convert it to a different type of investment, right? Then you've got something called your GIC, right? So that's your Guaranteed Investment Certificate. What it is, it's a secure investment that guarantees 100% of your original investment, okay? So you invest and you're essentially not really taking any risk. You know you're going to at least get back what you put in. You won't lose all of your money, okay? So as the years pass, you might have earned money and interest, and then something bad happened in the stock markets and the economy, and then you've lost your money interest, but this will guarantee that you will at least get back the money that you put in. Okay. Now with GICs, again, it depends on the institution. It depends which one you go with. There's a lot of different options out there. We're not going to explore all of them, but they earn interest at either a fixed or a variable rate. So you can say, okay, I'm going to lock this in at this percentage for this much time, or it will vary based on the stock markets, right? And again, that's where your simple and your compound interest formulas are going to come into play, right? Depending on which type of investment you have. Right, because of the safety of these, they typically have relatively low interest rates, right? Because they're safer in it, there's not as big of a risk you're being taken, so you're not going to get as big of a payout, right? So typically you only see these between like 1 to 2, maybe you'll get up to 4% on these. Okay, again, there's a large variety in types of GICs. We're not going to be exploring all the different types because they can vary by institution and who's offering what, but you should just know what a GIC is. Finally, you've got your mutual funds. Right? And your mutual funds are those collections of stocks or bonds. Okay, so that's really dealing in the stock market aspect of it. Okay, and the biggest event of a mutual fund is it allows multiple people and multiple investors to pool their money together to buy shares in a particular company, right? So if there's a bunch of people working in the same financial institution, the financial institution can take money from a bunch of different people and have a big pot that they can then invest in a share, and then as that grows, they can divvy them back out, right, based on who gave them what money. Okay. The thing is, though, is that with mutual funds, it's really dependent on stock markets and economies, right? So the interest earned is not fixed, and it is a more risky investment, and it's also not guaranteed to get you your investment back. You could lose more than what you invested. Okay. But at the same time, if you do get a payout, it could be worth the risk, and you'll get paid out at a higher interest rate. Okay. So these are all of our different types of different types of investments, and one of the ways we're going to analyze which investments are better suited is by looking at something called the rate of return. And the rate of return on an investment can help us compare which one kind of was the better option for us. And a rate of return is given as just a small, it's a percentage, it's a simple formula, where all we do is we take the interest that we earn over the term, divide it by the original amount that we've invested, and then just multiply it by that 100% to get it as a percentage. Okay? So we're just going to do 2 quick examples with this one. So in this first one, Anita has invested $3,500 in a simple interest savings account at a fixed rate of 1.75% per year for a span of 20 years. Okay? It's asking us 2 things. 1, what is the interest earned on her investment? And 2, what was the rate of return on her investment? Okay, so let's go through that one on the whiteboard now. All right, so information that we had from this particular one was we knew how much was being invested. We had a principal amount of $3,500. We were told that the interest rate was 1.75%, so I'll put that as a decimal, 0.0175, and it was over a span of 20 years, so our value for T was 20, and we were also told that this was a simple interest account, right? So because it's simple interest, we can actually use our formula for interest from our simple interest lesson, where interest is just equal to the principal multiplied by the rate multiplied by the amount of time. Right? We don't actually need to know what the future value is. We're just interested in the interest earned. So we just take the principal, multiply it by the rate, and multiply it by the time it was invested. So it's that $3,500 multiplied by the 0.175 multiplied by 20. Right? So $3,500 multiplied by 0.0175 multiplied by 20, and we get a value of $1,225 is the interest that's earned on that account, right? So that was part A. Part B then asks us to find what was the rate of return on her investment. So using that formula that I just introduced to you, we are going to do the following. All right, so 1225, I'm just going to keep that up there because I'm going to need it. Okay, so our rate of return, which you might see me in my notes refer to as just ROR, right? So rate of return is equal to, like I said, it's the interest that you've earned divided by the amount that you've invested, and then you're multiplying that by 100%. So in this case, the interest earned on this investment was the $1,225. The amount that I invested was the principal, right? We started off by putting $3,500 into the account. So all I need to do here is divide these, right? 1225 divided by 3,500. Right, that gives us 0.35, and then I multiply that by 100 to give me as a percentage. So the rate of return on her investment was 35%. Okay, so obviously the higher the rate of return, the better, right? And you can have rates of return that are more than 100%, because it would mean that you've doubled your money, right? If you get a 100% rate of return, it would mean that the interest that you earned is equal to the amount that you invested. So if you actually, over a long, long period of time, earn more interest than what you initially put in yourself, right? That was going to give you a rate of return that's over 100%. Okay. All right, let's look at that second example. All right, you'll notice here as well, I've already typed up the solutions for those people who can't watch videos, so they're there as well, exactly what we just did. And in this example, we are dealing with Roger. Roger invested $20,000 in a mutual fund 7 years ago. The interest he earns is compounded monthly. His overall rate of return is 63%, or 9% per year. What was the amount of interest that Roger earned over the course of his investment? Okay, so again, this is a question where we've been given his rate of return, right? So we're going to use that formula, but we're going to use it backwards, right? So again, we need to look at our key things. We know that the original amount invested was the $20,000, right? The fact that it's 7 years actually has no bearing on this first part of the question, because it's just asking how much he earned in interest, right? If it then asked how much did he earn per year, okay, well then we can go back and figure out what it was this way. But that 7 years is actually irrelevant to this problem. But we also need to know that overall 63%, right? All right, so let's start by solving what was the amount of interest that he earned over his investment. Okay, so again, with example 2 here, right, if we think about that rate of return formula, right, interest divided by investment multiplied by the 100, right, or 100%, right? We know that the rate of return was 63%. We don't know the interest. That's what we're actually solved to find. We're trying to find. And we know that the value of his investment was $20,000. So it's just doing the same steps, but in reverse, right? So the last thing we did going forward was multiply by 100%. So the first thing I'm going to do is divide both sides by 100, right? So if I divide by 100 here, that will cancel. And if I divide by 100 here, I get 0.63 is equal to the interest divided by that 20,000 original investment. Okay, now since this is unknown divided by 20,000, right, I want to get this by itself, right? So what I would do is I'd multiply both sides by the 20,000. Since it's being divided, I'm doing the opposite here. Right, so that will cancel, and then 0.63 times 20,000 is 12,600. Okay, so over the course of 7 years, he has earned $12,600. Okay, and then it's asking in part B, well, what's his current value of his investment, right? So he started off by investing $12,000, and over that 7 years, he ends up earning $12,600 in interest. So his his current value of his investment is what he started with, right? Plus what he earned in interest. And if we add these together, we get $32,600. That's what's sitting in his account right now, right? After those 7 years of investing, okay? All right, and again, you see those same things set up there. Okay, that's really the only new stuff. I did want to go over again the types of investments, so you should be familiar at least with, you know, what those investments are that I went over. Okay, so just know what they are, the pros and cons, what they stand for, kind of thing. And what you're going to do now is just have some independent practice. Okay, this is actually not going to be an assignment that I'm going to mark just yet. I'm going to wait till we kind of finish a couple things before I look at an assignment per se. And What you're going to do though is I've posted a worksheet that just has some investment questions, right, based on this kind of rate of return stuff for you to practice. So I've uploaded the worksheet. I've also uploaded all of the solutions. So that way, as you're working through the worksheet itself and you're thinking, am I doing this right? Did I get this right? Am I on the right track? You can compare it to the solutions that I have posted and say, okay, yeah, I see what I did wrong, or yes, I know exactly what I'm doing. I'm good. But then again, if you're still like, yep, don't know, solutions don't help, so lost, please email me. Please reach out. We can schedule a Google Meet session and I can try and explain it a little bit better. Okay, so again, that's your lesson on investments. You've got some practice questions. You're not submitting those, but please do them for practice. And then I'll be in touch again about what your next kind of follow-up task is going to be. Okay, and that's it.